How do we allocate our portfolio when we have a 72T? Hi, this is financial planner Sean Mullaney. Let's discuss. So 72T, I've done some videos on them. What I've done here is I've set up a little 72T plan for a 53-year-old, and I'm doing it to illustrate how I would approach portfolio allocation if I were doing a 72T plan, say in my mid-50s, right? So this is a person, they've got $2 million in a 401k. That's the lion's share. Maybe they have like $10,000 in a savings account and a paid off house, right? But otherwise, they got a traditional IRA. It's worth $2 million. They need $80,000 a year to live off of. And so the question is, well, one, what's that 72T IRA going to look like? What's the non-72T IRA going to look like? Basically, what we're going to do is we're going to split this IRA into two. One is going to be our 72T IRA. One is going to be our non-72T IRA. And from there, we got to figure out, well, all right, how do we allocate our portfolio thinking we have a 72T IRA and a non-72T IRA, right? So I'm saying we're going to begin this when I'm recording this in February of 2024. So we use the highest interest rate available under the fixed amortization method. That happens to be 5.79%, which was the December 2023 100% of midterm federal rate. We have of applicable federal rate. We have a 33.4 life expectancy off the table. And we want $80,000 a year as our annual payout, so we can live off that, right? That's why we're doing a 72T. We need money to live off of, and most of it's inside traditional IRAs, and we are under 59.5, right? We want to avoid that penalty. So we do our little calculation per the IRS under this fixed amortization method. We need to set up a 72T IRA of $1.17 million and some change. That supports the $80,000 a year payout, right? So we call our financial institution. We say, all right, I've got this one IRA is worth $2 million. I want you to split that into two IRAs, one worth exactly the 117,848.59 cents, right? So that will support my 72T. That will be my 72T IRA. So that's sort of locked up. And then I'm going to have a non-72T IRA, and that's going to be $829,000 and change, right? So then the question becomes, well, wait a minute. All right, I set up my 72T IRA, my non-72T IRA. I'm taking my $80,000 a year. Great. We're cooking with gas. But how do we allocate our portfolio? So I'm going to posit, look, I'm not giving you investment advice in this video. Okay, I'm just not. But what I am saying is I'm imagining a person who wants to have a 75-25 between equities and bonds, right? That's what their portfolio allocation fundamentally is. So basically, you do some quick math. We have $2 million in financial assets. 75% of that is $1.5 million. So that's our equity allocation. 25% of that is $500,000. That's our bond allocation. Well, where does that reside, right? So we have a 72T IRA and a non-72T IRA. My main thesis is this. We want to keep our 72T IRA stable and relatively modest. Okay, we want the 72T IRA to be relatively small, and we want most of our growth in our non-72T IRA. There's two main reasons for this. One is we like that non-72T IRA to be able to do some planning with. Maybe we want to do Roth conversions. That's a good IRA to have growth in, right? But where we don't want to have growth is in our 72T IRA. We want a stable asset in that. And look, your experience could vary. Who knows what stock market and bond markets are going to do? But generally speaking, stocks tend to have over long periods of time higher appreciation than bonds, right? It's just sort of the risk profile, the return profile. Generally speaking, we get into equities to have greater returns than bonds. Now, we're taking more risk, generally speaking, too. You got to do you on your investment analysis. But what I would say is this. We have a 72T IRA. That's a great candidate for the bonds, right? We don't want that 72T IRA to go to the moon. Well, why the heck do I say that? Well, if we start this at age 53, we may want to one day reduce our 72T payout. I did a video on that. The main way we do that is by switching one time to what they call the required minimum distribution method. That method keys off the size of the remaining 72T IRA. So that's a good IRA to not have so big, right? Let's say we invest that in some, to the moon stock. It goes to the moon. We get an inheritance at age 57. We want to reduce our 72T, but the 72T IRA went to the moon, we applied the RMD method, we thought we were going to go down, we might even go up theoretically, right? So we want that 72T to be relatively stable. We don't want big growth in there. So I would say that if we want a 72T IRA, and we're thinking about portfolio allocation, and we want 25% bonds, well, guess what? We should just put all our bonds in the 72T IRA. Okay, great. That means, though, the rest of that 72T has to be equities, and so that's an easy calculation on my little spreadsheet here. What we do is we take our 72T IRA, we subtract out the bond allocation, and that gets us our equities. And then guess what, right? We basically put all our non-72T IRA into equities. That's very easy, right? So, and Google Sheets even did some artificial intelligence or whatever it does. It figured that out for me. But that's how I would do it. Look, I'm not giving you investment advice in this video. I'm just saying that there are reasons to keep our 72T IRA as small as possible. Generally speaking, we do that through bonds. Now, some people are going to say, hey, wait a minute, what about sequence of return risk? Well, I'm here to tell you 72T is a separate concept, has nothing to do with sequence of return risk. Notice this person, right? They said, I want to do a 4% rule. I'm not telling you your safe withdrawal rate, but they're saying, well, I'm going to do a safe withdrawal rate, $2 million in financial assets. I'm going to take $80,000 a year. Some of you are going to say, well, wait a minute, that's not a safe withdrawal rate. They're taking 80,000 out of 1.17 million. That's way more than, than 4%. Some of you are going to say, well, why did you use that 5.79 interest rate? That's way more than 4%. Well, no. You have to look at it big picture. You don't look at little components. You look at the 80,000 divided by the whole, which is the 2 million. The 579 is just a way to keep that 72T IRA as small as possible. It's the biggest interest rate we're allowed to use. There's no sequence of return issue in a 72T that doesn't exist in the non-72T world, right? We retire, we don't need a 72T. 72T is a tax planning concept. It doesn't interact necessarily with things like sequence of returns risk, which, by the way, I tend to think is a little overblown in the world. That's a whole other video. But my main thesis is this. When we want a bond allocation, we have a 72T plan in place. Generally speaking, that's a good place to put the bond allocation. Let me know what you think about 72T, about 72T portfolio analysis. Hope you enjoyed this video. If you did, please mash that like button and subscribe to my channel. I'll see you next time.